Hello, and welcome. Today we're going to talk about some of the differences between bookkeepers and tax prep, accountants, and CFO advisors. I know there's a lot of differences in opinion about what some of these services are. We're going to talk about it. We're also going to talk about exactly what CFO advisors do. What are we even talking about here? So let's dig in. First of all, a CFO advisor, for purposes of this program, is someone who is managing the overall finances of a small or medium-sized business. Now, that can mean they are managing cash, they are doing budgeting. That can mean that they're just problem solving. It can mean a lot of different things. But here's the one thing that is important to remember. You can go from bookkeeping to CFO services. You can go from bookkeeping to tax. You can go just doing CFO. So what you need to remember is this. The difference between CFOs and bookkeepers. Bookkeepers are the ones who are classifying transactions. They are the ones who are reconciling accounts. They are the ones who get the numbers into the place where they're supposed to be, so we have good, accurate financial statements. Now, from there, the tax person could take that information and start doing the tax preparation, whether that's quarterly information or whether that's the annual return. Either way. The alternative path is that from those completed bookkeeper financial statements, that the CFO takes over, and the CFO starts analyzing all of that information, understanding what does it mean? How can we impact the future with it? How can we plan for the future? How is our business actually doing? So those are some of the differences. Now, CFO advisor, you're probably like, what is a CFO? Well, a CFO stands for Chief Financial Officer. Now, typically the term CFO is used in very large corporations. Now, that said, it can be used in smaller businesses. And you'll hear kind of the words CFO, advisor, advisory services thrown around, and typically those mean about the same thing. In fact, as you're kind of thinking it through, you can assume that a CFO and advisor, those roles are very, very similar. Now, let's get into what a CFO actually does when we're talking about them managing the financials of a small business. Well, the first thing is that they read and interpret the three financial statements. So the profit and loss, the P&L, the balance sheet, and the cash flow statement. So they read those financials, trying to understand, okay, what are these numbers telling us about what happened in the business? So remember, the bookkeeper is closing typically the month that just closed. So right now we are in the middle of July. Bookkeepers are working on closing the month of June. So we would be looking at, okay, how did the business perform in the month of June against either a budget or a previous period? So that is reading and interpreting the financial statements. What are the numbers telling us, so we can then come up with the story and how we are going to relay that information to the business owner. All right, so then the next thing that CFO advisors do is variance analysis. And variance analysis is basically taking every line on the P&L, on the profit and loss, and comparing what actually happened during the month, how much income came in, how much expense went out, to exactly what we budgeted or to that previous period, and why. The why there is the key. The why there is the most important part. We are looking to tell a story. We are looking to help that business owner understand what exactly happened in their business and why is it important that they know. We don't want to just give them the number, give them the percentage that they're off, and say, good luck to you. Our job is to tell the story, to tell them the why. So that is a very important key of CFO advisory services. The next thing that we typically focus on is developing and tracking key performance indicators. So typically known as KPIs. KPIs are similar to a variance analysis in that you're still comparing information, but instead of comparing it to the business itself, like you do in a variance analysis with the budget or the prior year, you're comparing it to a industry or to a group of businesses that do the same or similar type of thing. Maybe you compare it directly to a competitor. And you're looking for information around, okay, what are we doing really well that we can take advantage of that no one else is doing? Where are there gaps that we can fill in? We can also take a look at what other people are doing and how we can take that information and slide it into our business. If it's working for them, hopefully it'll work for us. So really understanding the differences between what our company is doing and measuring that against how other businesses are doing. If we're both florists, everyone's selling flowers, theoretically the numbers should align with what is actually happening within the business. It doesn't matter if you're florist A or florist B, one might be bigger than the other, but essentially you're going to have the same types of revenue, the same types of expenses. So the comps are very easy. All right, after key performance indicators, the next thing we typically look at is budgeting. Now, budgeting is done on an annual basis, and budgeting is more along the lines of helping the business owner understand what the targets should be, what's achievable, what's realistic for the next calendar year. So for example, does the business owner want to grow the business? And how does that look? Let's say we are a florist and we are selling different kinds of flowers. Well, maybe we're going to really go all in on roses. And we are going to sell as many roses as humanly possible. So as we're breaking out the kinds of bouquets that we're going to do, we're going to rose heavy them. That would mean that we are going to increase the revenue related to roses, also increase the expense, but understanding how those numbers are going to help that business owner achieve the goal. If we have revenue and expenses, if we have revenue and expenses, how are we going to manage those in the next year? Are we going to grow revenue? What's that look like? Are we going to sell more? Are we going to change the price? Are we going to develop a new product or service? What does that look like? And how do we build that up? And then on the expense side, similar concept. Typically you want expenses to go down, but if you're growing, sometimes those expenses go up. That's fine, as long as you're able to tell the story. So for example, you have your fixed expenses, things like rent, utilities, things that don't typically change month to month. You also have variable expenses. So things like material costs. If you are selling an item, how much does it cost you to make that item? You also have things like salaries. And depending on the kind of business that you're working with, that can be considered either fixed or variable. But typically, you want to be looking at the key expense lines, the rent, the salaries. Those are typically the big drivers, maybe material costs. So really helping understand what is going to happen next year to achieve those results that the business owner is looking for. The next thing that we typically do is cash flow forecasting. Now, cash flow forecasting is one of the most important things that a CFO advisor does because a lot of businesses, unfortunately, go out of business fairly quickly because of lack of cash. And there's a lot of confusion out there between cash and profit. We're going to talk about that another time, income. That said, What we're trying to do with cash flow forecasting is we are trying to help that business owner understand the timing of when the actual cash is coming in the door and the timing of when that actual cash is going out the door. So for example, let's say you sell a t-shirt. Well, you sell a t-shirt, person pays with a credit card. We kind of consider that cash because you get it into your account pretty quickly, a couple days. That, even though you sold it on Monday, you might not recognize the cash until Wednesday. So there is a difference between the timing of revenue and cash. Same thing on the expense side. So you might set up an automatic payment to go out of your account on, let's say, the first of the month. Let's say it's rent. We are going to track that cash actually does leave the business on the first of the month. Now, the purpose of this is that we are trying to really understand, do we have money to grow the business? Do we have money to pay our staff, to keep the lights on, to grow, to do all of the things that we need to do, purchase capital assets, things like equipment or trucks, cars. Those are the important items that we are looking to do with cash flow forecasting. Alrighty, after cash flow forecasting, we are going to focus on P&L forecasting. Now, budgeting, P&L forecasting, cash flow forecasting sounds similar. Budgeting and cash flow forecasting are very similar. The difference is within the timing. So budgeting is for the next calendar year, whereas P&L forecasting is for the remainder of the current year. So right now we're in July. We would do a P&L forecast for the rest of 2025, and we would do a budget for the year 2026, but all put together very similar. Now next, we do long-term strategic planning. So hopefully we've got some business owners out there who have more goals than just a year away. What's going to happen next year? They have 2, 3, 5, 10-year goals, and we want to know how can we help them achieve those. And that's where long-term strategic planning comes in. And it's basically reverse engineering the entire process. So you've got your goal. Let's say within 2 years, the business owner wants to increase revenue 10%. Great. We can help them do that. How? Well, if we're going to increase revenue, we better have some plans as far as what kind of levers we can pull within the business. Should we do a price increase? And how much will that grow the business? Should we develop a new product or service? Should we sell more of the items that we have? Should we, as we're thinking through the increasing price, what does that mean from a volume perspective? I don't know about you guys, but if the cost of my favorite thing goes up $10, do I still want to buy it? Maybe, maybe not. It depends. So we have to take into account how the price impacts the amount that people purchase. So, okay, let's say you're going to grow 5% in year one, 5% in year two, total of 10% annual growth. Well, 10% growth over the 2 years. So what are the building blocks to do that? All right, we are going to increase price on this date by this amount. We are going to launch a men's t-shirt in color green on this date. This is the person who's responsible. So it's really the working backwards, putting the building blocks in place so you can really understand and put into action those plans. They're not just far off, thoughts that the business owner has, that we actually are putting some numbers around them so we can measure, how are we tracking? Did we do the price increase when we said? Did we do it the amount that we said? Did we launch that product? How does all of that work out? And how does all of that impact our ability to achieve that goal. All right. And then finally, we have financial planning and analysis, which is a fancy way of saying problem solving. So I don't know about you guys, but I love a good puzzle. So what we mean by this is answering those everyday business questions, things like, okay, if we're going to grow the business, how are we going to do that? Should we lease a piece of equipment or should we buy it outright? If we are going to increase our staff, when should we do that? Should it be full-time, part-time, contractor, employee? What the hours should be? How does that stack up then against when our store is busy? So we're really going to want to understand how in the world we're going to solve this problem. Because here's the key. If we do it right, we can really help that business owner avoid mistakes and make a decision already knowing the likely outcome of it. So for example, let's say that business owner is trying to say, you know what, I don't know, should we lease, buy? I don't know, we got to buy this car, not sure what to do. So you take it back, you do your financial planning, your modeling, and you say, okay, well, this is how much interest rates are if we buy. This is how much the car costs today. Do we need to factor in a tariff? How does that look? And then same thing on the leasing side. Does it make sense for us to have this item short term? Is there something else that we can do with the money? So things like that. And that is what CFO advisors do. All right. Well, I hope you enjoyed that. If you have any questions, please be sure to leave them in the comments below and I will get answers to them and we'll chat next time.